Hello, everyone, and thank you for joining us today. My name is Valerie Rundquist. I am the Senior Program Officer for the Endowment Partners Program, and my pronouns are she and her. Welcome to Endowment Partners 101. Some of you may have attended one of these sessions in the past, but this is the first time we've used the Zoom webinar format. So please know that this session is being recorded, and a link to the recording, along with copies of the slide deck, will be emailed to everyone that registered within the next couple of weeks. They will also be available on OCF's website. Of course, questions are welcome. True to any webinar, everyone is in listen-only mode. Please use the Q&A feature to submit your questions. We will pause periodically and at the end of the program to answer questions. And I'll just also add, please use the Q&A. It's much superior to the chat feature. Closed captioning is enabled. This is where I have to look at my notes. So to control the closed captioning feature, look for the CC and click on that, hide subtitle, or if that doesn't work, go to more and hide or show subtitle. So that's how you control your subtitles. Today, I am joined by Stephanie LaPierre, Associate Program Officer for the Endowment Partners Program, Julie Gregory, Senior Philanthropic Advisor and Regional Director for Central Oregon, and Jennifer Grimes, our Event Marketing Coordinator, is hard at work in the virtual eves running the show today. Thank you so much, Jen. Today's session is really an accumulation of all the day-to-day questions that and topics that Stephanie and I deal with. So I wish I could make this more exciting and more entertaining. I admit it's quite dry, but it's a very practical session. So we want to talk about, I'm going to start at high level, that's my MO. So community foundations like OCF, how the Endowment Partners Program fits into that. I'll spend a little bit of time talking about endowment and the definition of endowment, then how we invest and administer these funds. And then towards the end, Julie Gregory will join us and talk about ways that OCF can support your organization in building your endowment. Yesterday, I believe it was yesterday, that we emailed out some additional materials, which I'll reference a few times during the presentation. There was a packet of supplemental investment information, a copy of our Endowment Partners Handbook, and our brochure for planned giving for endowment partners. There's some additional reading for your nighttime reading pleasure on the Unified Prudent Management of Institutional Funds Act, MIFA, how to account for these types of funds on your audited financial statements in accordance with GAAP, and some information on gift acceptance policies. If you didn't see that email yesterday, no worries. Stephanie is right now in the process. Oops, Stephanie just posted it in the chat, so you can access it there. If you are viewing this program as a recording, just go out to OCF's website, oregoncf.org, search on Endowment Partners, and then scroll down and look under resources. All right, then, I'll take a drink of water and let's get started. So I'm starting with information that you undoubtedly probably know, but I just want to set the stage. So most basically, foundations are funders of charitable purposes. They are, of course, far more complex than that, but most simplistically, they are grant makers. So with a private foundation, quintessentially like the Bill and Melinda Gates Foundation, what makes up the assets that provide those grants out to the community are relatively from few sources. So here we have Bill and Melinda, Warren Buffett, just a few sources. And in this case, you can see they make grants globally. I like to think of the IRS 501c3 status kind of as a fence. So on one side of the fence, you have private foundations. On the other side of the fence, we have public charities. So OCF is a 501c3 public charity, just like any other, just like everyone else in this room. And Jen, I'll need the next slide. So yeah, community foundations, we are public charities, just like all of you. And I really see it as community supporting community. We accept donations from the community, from individuals, families, corporations, both for-profit and nonprofit. And then those donations establish funds at the community foundation that make grants and scholarships and endowment distributions out to our communities. Community foundations tend to be place-based, and so they are focused on a geographic area. So obviously, OCF is focused on the state of Oregon. And we have some construction going on downstairs, so I hope you're not having a hard time hearing me. That's a little distracting. All right. So I talked about all those donors, all those different types of donors, and they have established well more than like 3,000 funds, I believe it is. So I'm going to step back for a moment and hand it over to Stephanie, and she's going to spend some time talking about those funds and different types of funds at OCF. Take it away, Stephanie.
Thank you, Val, and good morning, everyone. So as Val was saying, OCF is comprised of many types of funds, and together they support diverse objectives in a variety of Oregon communities. And these various fund types are organized by how grant recommendations are made from them. And we have some fund types listed here. So with discretionary funds, OCF's board determines how those grants are executed. And discretionary resources are what fund OCF's community grant program, which is our longstanding and ongoing statewide responsive grant program. However, only around 20% of OCF's overall grant making is from discretionary funds, whereas the rest is really donor driven. And speaking of donor driven, next we have advised funds. And this is where there's active philanthropy taking place. Advisors to these funds make recommendations to OCF on how they would like to see the grants made. And those recommendations can come from individual advisors or committees, which can be comprised of community members or staff from organizations who have created corporate advised funds. With scholarship funds, committees make those decisions. And finally, we have designated funds, where the grantee or grantees are designated at the time the fund is established, and the fund provides regular grants to those beneficiaries like clockwork every year. So of all the fund types at OCF, we want to draw your attention to designated funds specifically, as this will help us back into the mechanics of these endowment partner funds. Next, they're perfect. So there are two types of designated funds. The first is donor designated, and that's where the donor can be an individual, a for-profit business, or a nonprofit organization, but the grantee must be a 501c3 public charity. In this case, the donor is not the same entity as the beneficiary, which might sound odd until we get to the second type of designated fund. And donor designated funds constitute a classic endowment established by a donor and maintained in perpetuity to provide an annual income stream. Now, the second type of designated fund is called an agency endowment fund. And this is when a 501c3 public charity establishes a fund and designates themselves as grantee. So in this case, the nonprofit who establishes the fund is both the donor and the beneficiary to that fund. And these are the funds that comprise the Endowment Partners program at OCF. So we call these funds endowment partner funds because OCF has partnered with our fellow charitable organizations to support their efforts in building resiliency and sustainability through establishing endowments, which ultimately strengthen our state. And OCF has partnered with approximately 440 organizations who have created 780 funds, amounting to around $293 million in endowment for Oregon's nonprofits. So on a technical level, your organizations have created designated funds at a community foundation for your organization's own benefit. And a key takeaway here is that just like the other funds OCF administers, these endowment partner funds constitute a legal transfer of ownership, and your board made a donation to OCF to establish the fund. And that legal transfer of ownership is indeed necessary for a few reasons. The first being IRS regulations over community foundations. So OCF is structured as a single incorporated entity with component funds, and the foundation must legally own these funds to adhere to Treasury regulations and avoid having each fund considered to be a separate entity. The second reason would be SEC and state regulations. Simply put, OCF is not a registered investment management firm or consultant, so we can only invest our own assets. Now, you might wonder why organizations choose to do this and why they might choose to partner with OCF specifically. Well, listed on the next slide, there we go, are the primary benefits, and they include access to investment expertise and the inherent benefit of investing in a large professionally managed investment pool. So Val will discuss this more later in the presentation, but the size of OCF's main investment pool allows organizations who participate to access exclusive institutional investment managers that even our largest partner organizations would not have access to on their own. The program creates efficiencies. You can focus on your mission without overseeing the administrative duties and ongoing oversight of a complex endowment program. You also receive access to planned giving advice and complex gift services. If you're not already able to offer life income gifts like charitable gift annuities and charitable remainder trusts, OCF's development staff can work with you and your donors to help set up these gifts that ultimately benefit your endowment fund. If someone comes to you with complex assets like real estate or artwork, OCF staff can get you pointed in the right direction and connect you with our in-house expertise. And while they cannot handle the gift of a complex asset entirely for you, they can help serve as your planned giving back office by connecting you with resources. So it's just another tool in your toolkit. And Julie Gregory will be discussing these services later in the session. And we also plan to continue offering future webinars which expand on this topic. Another benefit is that OCF endowment partner staff provides subject matter continuity and ongoing education on endowment for changing boards and staff. And we're currently building a resource library of past webinars for endowment partners to access on demand as well. And you can find past webinars on the Endowment Partners page of OCF's website under the resources section. So these are the primary benefits, but there are some softer reasons too that we've heard from organizations regarding why they take these steps. Some donors like the idea of a double lockbox that OCF provides when it comes to endowment. They give a gift to an organization restricted to endowment, and that's the first lock. The organization must honor that restriction. But by transferring the gift to a community foundation, there's a secondary level of stewardship, and their endowment will continue to support the mission that donor was passionate about in perpetuity, even if any one organization had to close its doors, and hopefully that would never happen. Also, some nonprofits like the idea of working with a fellow nonprofit organization since it might be more mission aligned. The administrative fees on these funds stay in Oregon and they go towards a mission that works to improve the lives of Oregonians rather than a for-profit money manager. And while the benefits on this slide are indeed offered to our partner organizations specifically, we do want to quickly address something we get asked about, which can be misunderstood as a benefit of the Endowment Partners program. And that is that participating organizations may receive greater access to OCF's advised fund donors. So of course, OCF does not and cannot show any grant-making bias to endowment partner organizations. However, we do offer a newly revised tool that's available to all organizations, regardless of whether they're an endowment partner or not. And we want to take a moment to highlight it briefly. So this feature is called the Organizational Profile Tool, and it provides nonprofits with a way to update OCF and our donors on projects they're working on and current funding needs, as well as who they serve. So what's different about this is that it's not a funding application, but is instead, we hope, an easy way for you to update OCF staff who work with donors to funds across the foundation, as well as an opportunity to share this information directly with donors. So these profiles are searchable by donors through MyOCF, which is OCF's online portal, as well as through OCF's Giving Navigator tool, which is publicly available on our website if you'd like to see its functionality in practice. Donors can type in the name of an organization they're already interested in, or they can search by some filters like arts, for example, or a specific geography within the state. And it looks like Val has posted a direct link in the chat, which includes more information on how to complete an organizational profile. For anyone watching this later, that link is also included on this slide, copies of which are available on OCF's website Endowment Partner page. So this is a great time to pause for a question or two, if any have come up. And just as one last reminder, please do use the Q&A section so we can more easily capture your questions.
I am not seeing any questions so far.
Okay, great. Well, maybe we'll get just a another second here and then we'll move right along.
Oh, Monica raised her hand. Monica, can you post your question in the Q&A? I don't think I have the ability to turn on a mic, so. Okay, well, apologies, Monica. We will go ahead and move on. And if you want to type anything in the Q&A, we will definitely pick that up later on in the session. So we will keep going at this point. Jen, why don't you go ahead with the next slide? All right, so now is the time when I talk about endowment and the definition of endowment. And this is important because how we define endowment really drives how this program is designed and how the funds are managed. So most generally speaking, it is just a long-term fund set aside to support your organization. Naturally, we're going to narrow it down. We want to take a look at how it was created and how it's going to be used. Was it created by your donor or by your board of directors? Is it going to be used for an annual income stream, or is it really a rainy day fund? True endowment can actually can only be established by a donor's restricted gift. The Unified Prudent Management of Institutional Funds Act says that the restriction is made in a gift instrument. But what is a gift instrument? Hopefully, it's a nice, clear, concise gift agreement between the organization and their donor. But it can also be very simple. It can be as simple as the donor checking that little box that says endowment on the bingo card mailing you sent them and returning that with their donation check. However, if you accept that gift, then obviously you cannot spend it outright and you are obligated to maintain that gift into perpetuity. So this is the type of endowment, this true endowment, that provides the annual income stream back to the organization. It diversifies, as Stephanie said earlier, it diversifies revenue sources, providing resiliency and sustainability for the organization. There can be an additional restriction, of course. Suppose the donor wants to endow one of your programs, and that's very good. That's great. I just bring that up to say that OCF doesn't get involved with that. So we are not going to document your donor's restrictions, and we cannot steward them. If we did, if we actually embedded the donor's information into our fund agreement, then you would be obligated to report back on the distributions to your organization from your own fund. And that seems pretty unpalatable for everyone. So we don't do it. And I do have organizations occasionally come to me doing some research, 20 years ago, 30 years ago on their donors, and they don't understand the origin of their own endowment. And unfortunately, I don't have anything for them. So my finger wag here is please make sure you keep good records on behalf of your successors and your donors. And of course, a board can establish an endowment fund. Next slide. Yeah, there you go. So of course, a board can establish their own endowment. You might hear other terms like quasi-endowment or funds acting as endowment. But same thing, you have a wise board, they set aside, they establish policies and procedures and resolutions and get all that structure in place. But then a crisis comes along, and of course, they're going to tap that fund. And unlike a donor restricted endowment, there is no legal ramification to that. So when push comes to shove, really a donor designated endowment is often considered a long-term emergency reserve. And there's nothing wrong with that. In fact, you absolutely should have that reserve. Please have those reserves, but please don't have them at OCF. What if that emergency was an economic emergency? I always hearken back to 2008 in the Great Recession when that was hitting. And that year, OCF was, our investment returns were like negative 28%. And our returns were better than other institutions. Well, when you're in negative territory like that, that's exactly when you do not want to be taking a lump sum distribution from your endowment. Endowment really is meant to ride through those crises and the ups and downs, and that is how OCF manages our endowment as well. So reserves are vital. Please have reserves, but reserves are not endowment, and they should not be at OCF. So to drive it on home in this context, on the next slide, we will see that OCF's definition of endowment is a fund maintained in perpetuity, a true endowment that provides that income stream back to the organization. So it's OCF's goal to manage that fund in a prudent manner so it is preserved for future generations. And to do that, we consider both how the fund is invested in the investment goals with how we spend from it. So now we will pause again for a few more questions. Here's your chance to. Wow, we must be answering everything just perfectly. Okay, well, you must have questions later on. I see TJ raised his hand as well. Jen, is there a way that we can unmute folks so they can ask their question?
So Val, we did have some questions. Here's one. It says, what happens to the endowment fund if a company dissolves? Okay.
Well, the fund agreement has built into it, and if you want to go look at your fund agreements, it's usually towards one of the very last clauses. It's usually the last clause in the fund agreement, and we call it the contingency clause, and it outlines that OCF will work with remaining board members in order to assign a successor beneficiary to the fund. So the intent of that endowment fund carries forward into perpetuity, but with the assistance of any remaining board members, we will assign a successor that is as closely matched to the original organization as possible.
Okay, great. We have quite a few. So do you want to take another one? And then I know that TJ wanted to speak. So what?
Can TJ do that, Jen?
Yes, I've given him permission and asked him to unmute. So we'll see if it can work on his end.
While we're waiting for TJ, I think I'll go ahead and answer another question. How and when can you remove endowment? Can you remove endowment fund if you had to? Granted, that is always to be avoided. You would have to contact me or Stephanie and have a discussion about that. And that would require permission of OCF's board. So it may or may not be possible. It is a substantive conversation. So just go ahead and reach out to me or Stephanie. And there's a prior question, can we decide when we want to receive a payout from our endowment funds? Yes, you can. Our typicals, Stephanie will be addressing this later on in the administrative section. So I'm gonna put that question on hold. Yeah, I'll put that question on hold for now.
Is it Hi, this is TJ here.
Hey, we can hear you, TJ.
Is it possible to have concurrent endowments? So having one that's board restricted and having one that's donor restricted type thing?
Well, you certainly can have more than one fund at OCF.
Okay.
And organizations do that. They will have, I mean, because you really don't want to commingle those different types of endowment. So that's probably a wise thing to do. But if you do want to establish a separate fund, say that's just the restricted monies, it does have to be a minimum of $25,000. So we can also have a conversation about that. All right, so you know, with the interest of time at hand, let's go ahead and move on to the investment program. All right, next slide, Jen. So remember all of those thousands of funds that I mentioned? Well, those funds that are endowed, and not all of them, not every donor fund at OCF or any community foundation is necessarily endowed. Those that are endowed are invested in one or both of two investment pools at OCF. We have the main investment pool and the social impact pool. So in that supplemental packet I mentioned, you do have the full investment policy. Of course, we're not going to read through that today. So this is just the overarching goal of the investment policy and investment program. And what does that look like with endowment? I mean, remember, the investment horizon for endowment is forever, at least centuries. So a big consideration in this case is the risk and the impact of inflation on the assets. We want to earn enough to stay ahead of inflation. That's what they mean by purchasing power, so that the distributions and grants we make 100 years, 200 years from now have the same impact that they have today. At the same time, we need to provide for our current grants, scholarships, and endowment distributions. And of course, we want growth, genuine growth on top of that. But at a bare minimum, we want to maintain that purchasing power while still earning enough to meet our current granting needs. The social impact pool has the same goal, of course. It's also endowment, but it has the extra layering of those ESG screenings. And I'll mention here with the social impact pool, about 5 or 6 years ago, we were successful at divesting that pool entirely of any asset, any company that is associated with the fossil fuel industry at all. So it is completely divested of fossil fuels. All right, so we've looked at the goals of how we're going to invest. Now, how do we expend? How do we spend off of the endowment? And we have that balance. So this is governed by a spending policy. All endowments, all nonprofits with an endowment are required to have a spending policy. And you'll find that full spending policy in that supplement packet. It is embedded within the investment policy. So this is pretty typical. OCF spending policy is very typical. It starts with a modest, prudent payout rate. With OCF, it's between 4 and 5%. Our board of directors meets every August. Excuse me, of course they meet every August. They meet quarterly, and it's at the August board meeting that they take recommendations from our investment committee. Our investment committee has worked, they get out their best crystal ball, they look at the economy and consider what they think the markets can provide, make that recommendation to the board, and the board approves the payout rate for the following calendar year. So in August 2021, they approved a payout rate for next year of 4.25%. Then we take that rate and apply it to an average of market values. That averaging provides a smoothing effect and a certain amount of predictability of that distribution and income stream back to your organization. So in OCF's case, it happens to be 13 quarters. So average 13 quarters, cut it off at September 30th, and that is the math and how we calculate for the next calendar year. And I'll also add something that's not in black and white, but that we do in practice is to adjust for contributions that are made to the funds. So for example, any contributions that you made to your funds in 2021, next year's calculation, you'll see an immediate bump in that amount. So it doesn't just go into the general averaging on 13 quarters of averaging. You'll actually see an immediate increase in the payout amount the following calendar year. So I want to go back to those rates. So you're going to notice it's going to jump right out at you that next year is slightly lower than this year. And if you remember what we paid out last year, well, 2021 was slightly lower than 2020. So it's pretty obvious that OCF is very minimally pulling back on the payout rate each year. And I want to talk about that. There are a couple of reasons for it. One is I mentioned that that smoothing effect that we use for averaging market values. So this is part of that. So as we see markets and valuations go up and up and up, and the value of your fund goes up and up and up, and that's a really happy environment to be in. But we, as an offset, that is why we're slowly pulling back ever so slightly. So it provides, again, that offset effect. For example, this year, even though the payout rate this year was lower than last year, in most cases, the actual calculated amount was a higher amount. And I predict it'll be the same for 2022. Conversely, if the markets start coming down and we have some corrections, or there's just a continual lowering of returns and market values, then you're likely going to see OCF increase the payout rate. But another aspect to those valuations and the high market values is that, equities, you probably hear it over and over again, equities are very expensive right now. And in that environment, there isn't a whole lot of optimism for what future returns might look like. So those are a couple of reasons why we've been pulling back on the payout rate. So here we're looking at the structure. Again, a typical nonprofit structure. OCF's board of directors are at the top of the pile. They have ultimate oversight. They approve policy, but delegate the day-to-day oversight of the investment program to the investment committee. So it's the investment committee's role to set strategy, monitor performance, hire and fire managers. They do meet every quarter, just like the board does. And they are supported by our hired expertise, our investment consultant, Cambridge Associates. So they assist the committee in reviewing fund managers and setting a strategy for the investment program. Cambridge Associates is, they were founded in the same year actually that OCF was, in 1973. And they are a very well-known international institutional investment consultant working with other foundations like OCF, endowments, pension plans, and wealth clients. They really are considered the gold standard of the investment consultant world. They have a very deep research platform. They have, I understand, 250 staff that are constantly searching the investment universe for the best and brightest. They do all the upfront due diligence with these potential managers. And then once they begin working with these managers, they provide due diligence on an ongoing basis. We have a dedicated team ourselves of 5 analysts who specialize in specific areas. For example, like private investments or hedge funds or real estate investments. So lots of specialized expertise there. And so they provide these recommendations to our investment committee on hiring and firing and setting strategy. But this committee, by no stretch of the imagination, is a rubber stamp committee. There are often very robust conversations, and they don't always approve the recommendations. So very, very healthy two-way conversations with Cambridge. So you can see at the bottom there, the 2 pools, the main investment pool and the social impact pool. So as of June 30th, the main pool is at $2.3 billion and the social impact pool much, much smaller at $168 million. And here you see our committee of volunteers. There is always some overlap with our board of directors. So for example, Bill Berg, the investment committee chair, is also our treasurer, and Kimberly Cooper is our board chair. And it goes without saying that there is a tremendous amount of investment and economics expertise on this committee. If you're interested in their full bios, those are available also in that supplemental packet that we provided. All right, investing endowment. I already mentioned centuries, perpetuity, forever. It's really evolved a lot over the centuries, like any investing has, but particularly I would say in the past 60 years. It used to be that endowment, in the centuries ago, endowment was really comprised of real estate, of agriculture, a farm. I mean, for example, the Harvard endowment, everybody knows about the big Harvard endowment. It was started in the mid 1600s with a gift of land, and that land was converted into an apple orchard. So that was pretty typical. Agriculture was the endowment. Of course, later on, they started investing in more fixed income type investments like bonds. But then they began to realize that those types of investments were not keeping up with inflation, just like what I mentioned earlier. And they started diversifying into equities. And that was quite the to-do back in the day because that was so risky. But now we look at today's model of endowment investing, and there's actually this very high emphasis to equities, this high allocation to equities. And because there is inherent volatility with equities, then we need broad diversification. And the alternative category, by alternative assets, we mean any type of asset that is not the usual equity, bond, or cash. And by alternative investment strategies, and an example of an alternative asset, would be like, believe it or not, real estate, or particularly privately held companies, those that are not available on the public markets. And then back to those strategies, alternative strategies, like marketable alternative strategies, are the hedge fund managers. And these are the strategies that are meant to provide performance that is uncorrelated with what the markets are doing at any given time. So this chart is the why. This is $1 invested in early 1900 and how it performed invested in each of those three categories, equities, bonds, and cash, over about 115 years. So that blue line of equities, it's pretty obvious that's where you need to be to get the returns to meet those goals that I was talking about earlier. But looking at that blue line, you can see it is also the bumpiest line of the three. And that's why in this next chart, you can see why we want to diversify. So yes, volatility absolutely matters. And this chart is put out by a firm in the Bay Area by the name of Callan Associates, the Callan Periodic Table. Anybody can go get it. But what it's doing is comparing asset classes and capitalizations from year to year, ranking top to bottom. So you can see that in any given year, you can't really predict who is going to be on the top and who is going to be on the bottom. And that's why we want to keep our eggs in a variety of baskets and not just have everything in one allocation. So here we start to see some of the actual strategy of our main investment pool. So this is talking about different asset classes and the roles that they play. We're aiming to maximize returns, but still mitigate risk. The concept here is that returns are driven by a strategic asset allocation rather than individual security selection and market timing. Each of these components will serve one, maybe two strategic roles in the portfolio. So equities, that's the growth section. They are the growth engine driving returns. But even within that, private investments, these private investment managers are meant to provide superior returns above the public equity markets. Then we have hedge funds, the marketable alternative managers. They're meant to provide a good return, but with lowered risk. Commodities and real assets, their role is to hedge against sudden economic events, like particularly in this case, inflation. So sudden inflation, you have commodities that are going to rise with, their values rise with inflation. So down below, pardon my froggy throat, you see the diversifying section. This used to be, you had equities versus fixed income. So now we have growth versus diversifying. So there is still fixed income within that diversifying section, but there are other types of assets like the marketable alternatives that will use equities as well, and some more private investments. But regardless, this entire category is meant to be fixed income like and add ballast and protect against sudden deflation and economic downturns. So here we see those roles actually start to be applied in actual percentages to the main investment pool allocation. And this is the allocation, mind you. This entire investment presentation is all, the numbers are all as of June 30th. So you see that strategic target. They are moving towards a 75-25, but for right now it's 79-21 overall. But you see the range there on the right. That range provides some wiggle room so that our investment committee can look for opportunities and make those shorter term tactical shifts that may be necessary. In the social impact pool, being much smaller, like I mentioned earlier, it's a simple portfolio at this point. It does not have the diversification that the main investment pool does. It has 5 very quality institutional mutual funds. As it gets closer to $500 million, 500 million, that's the time when they will be able to access these other kinds of managers, and they'll be able to increase the diversification in the social impact pool. So that will happen at some point. And here, finally, proof of the pudding. We have some actual returns. You've seen the performance for the main investment pool. The first thing that jumps out there, you'll see we have final versus preliminary returns. Why is that? Well, I've been talking about the private investment managers, and by the nature of those structures with limited partnerships, owning companies, and just they're kind of cumbersome, and it takes a long time for us to get their performance numbers. So as a result, the private investment numbers are always about a quarter behind. And they are increasingly a higher percentage of the portfolio. Right now, they're at about 24%. And on top of that, they have been doing very well and are very additive to the performance. So we wouldn't be doing ourselves justice if we didn't, instead of just reporting the most recent June 30 returns, we're doing an injustice to everyone if we don't provide those final returns as of March 31st. And I'll just throw out there the preliminary, if you look at the March 1 year at 46.1%, which is crazy. Well, the preliminary return without the privates was 35.1%. So incredibly additive to performance. The other thing I want to talk about there is that benchmark. So what Cambridge does for us is provide this blended custom benchmark, and they'll apply the respective indices appropriate for each asset allocation, blend those together in accordance with the targets and compare the overall performance to that. Generally speaking, though, it's the growth section that I mentioned is compared to the All Country World Index, so a global index. And then the diversifying section, meant to be very fixed income like, then is appropriately compared to the Barclays Aggregate Bond Index. And the details of that custom benchmark also in that supplemental packet. So next slide, we see the social impact pool returns, also very good and strong returns. Even with that simple portfolio, it has at times outperformed the main investment pool. So it's a very strong program. And the benchmark in this case is a clear-cut 75-25 All Country World Index to Barclays Aggregate Bond Index. So the next slide takes that Callan quilt chart, and Cambridge has taken those indices that I mentioned that we rank our own asset allocation to. They take those indices and rank them each year, just like the Callan chart, but then they've plotted OCF's return within that. And so what this really is exemplifying is that our attempt to dampen volatility is working. You don't see us either swinging to the very top or down to the very bottom. So I like to quote our investment committee chair, Bill Berg, on this chart. He likes to call this the dare to be mediocre chart, which is amusing. But what it's really saying is that we're not aiming at maximum growth. Rather, we are aiming at sustainable growth with lowered volatility. So this chart, I've been talking about volatility. Well, it's, within volatility, you also have market cycles. So this chart is looking at some of those cycles over about a century as compared to an average return of 10%. The point with this chart is that we know there will be cycles. We know there will be peaks and valleys, and sometimes there will be negative numbers. A couple of weeks ago, I was reading an article that had a quote that I think fits really nicely with this chart. And so I'm going to read it. And the author's name is Taylor Tepper with Forbes Advisor. And he said, recession inevitably ends with a recovery, which leads to another rebound, which always ends in a crash. That's the nature of the economic cycle. What's important to keep in mind is that the dips tend to be much briefer than the booms. And over the long term, markets always trend upwards. And that's what we rely on. So this chart is similar to that other chart. You can actually see two distinct downturns, the dot-com downturn and the Great Recession. But this is a favorite chart because it's an actual endowment partner fund that was established 28 years ago with a nice even $100,000. They took their distributions like clockwork, and the orange line there is the purchasing power. It is that $100,000 indexed for inflation, then with that blue line being the bumpy market value line. So you can see on the far right, we are achieving that goal of staying ahead of inflation. We have some growth. At the same time, it has provided an annual income stream to the organization totaling around $219,000. So this really exemplifies the power of endowment. And that's all I have for the investment program. So let's pause again for a few questions.
So while we wait for some more questions to come in, Val, we did get one in the Q&A and it was answered in the Q&A, but for the good of the order, I'll just pose it to you here as well. And the question is the payout the same as the growth rate?
No, that's kind of the whole point. So basically, are the returns the same as the payout rate? Did I hear that right?
Yes.
No, and that's the idea. I mean, we want, the payout rate is a component of the goals. So we want to stay ahead of inflation. So the overall performance on average over time, that goal is comprised of what we want to pay out. So we hope that in the long term, the payout rate is less than the overall performance, because we also have to deal with inflation as well, and we want some growth. So the payout is one piece of what we're trying to achieve.
Great, thanks. And then we have someone here who liked your chart, and they're asking, can I get a chart like the last one for my organization?
Maybe. No, go ahead and email me, and I'll see what I can put together. Absolutely. And our emails are at the end of so yeah, you'll have our emails. All right. Any other questions? With that, I'm going to rest my voice, hand it over to Stephanie, and she's going to talk about administration. Thanks, Stephanie.
Great, thank you. Next slide, please. Perfect. So this is a sample endowment partner fund statement. OCF provides quarterly fund statements, which become available approximately 5 weeks or so after the close of each quarter. And OCF's main investment pool, it has over 100 investment managers, as Val was saying, and due to its size, it typically takes 3 to 4 weeks before our finance team receives enough of the statements to create a valuation, resulting in that 5-week statement delay. Interim monthly reports can be available upon request, and OCF does offer paperless statements, which are the quickest option for statement delivery, and those are available online through My OCF. If you're not already enrolled in paperless statements and you would like to be, please reach out to Valerie or I, and we'll be happy to set that up for you. OCF's finance department collects those manager statements and they perform valuations on a monthly basis. Our database knows which funds are participating in which pool or pools and allocates returns accordingly, generating the top 4 figures on the statement, which represent the investment return. Returns are reported net of investment management costs, and every fund receives the same rate of return as the other funds in the pool. However, of course, there are more costs to investing than can be shown in black and white. And a classic example would be the expense ratio on a mutual fund. So in your own IRAs, you know your manager is getting paid, but managers' fees aren't listed as a line item and are instead taken out of the total value of the mutual fund. Another example would be private investors who may get a performance or incentive fee only if they crest a certain amount, which we also don't see reflected on statements. OCF itself does not assess an investment management fee, and Cambridge Associates negotiates investment management fees on our behalf and provides a regular evaluation of the investment fees to be reviewed by OCF's investment committee. So when you add to your funds, as we've discussed, these funds are unique as they're a relationship between 2 organizations. And endowment partner funds also have a unique accounting treatment under generally accepted accounting principles, or GAAP, which prevents OCF from accepting gifts directly from your donors into your endowment fund. Essentially, GAAP says that community foundations should account for these endowment partner funds as an asset, but also with an offsetting liability because the funds are deemed to be reciprocal, with a portion being distributed back to your organization. Now, donor designated funds, on the other hand, are a straight up gift to OCF, no mutual benefit. So we account for them solely as an asset. And you can see this on OCF's audited financials. And this is just a distinction between agency endowment funds and donor designated funds. The 2 types of funds receive different accounting treatments. So the salient point here is that when soliciting endowment donations, please ask your donors to make their gift directly to your organization, which will acknowledge the donor. And then you can then forward those donations to OCF, and OCF will acknowledge your organization. And this simply allows OCF to adhere to these accounting rules. So we've discussed the spending policy and the calculation that determines the annual payout to your organization. If you're a visual learner like me, there's also an example of that calculation in practice on page 5 of the Endowment Partners Handbook, which was included in the materials. But a standard distribution schedule is semi-annual, with half in June and half in December, although some organizations do opt to take their full distribution in either June or December. You can receive distributions via direct deposit or check, whichever you prefer. And you also have the option to reinvest the available distribution amount, essentially foregoing it for a period of time or indefinitely in order to help the fund grow more quickly. Annual available amounts are not all or nothing. You can take just a portion of what's available to you if you'd like. Just let Valerie or I know prior to your regular distribution schedule, and we can easily make that adjustment. Something to note, though, is that annual available amounts do sunset at the end of each year. So if you did decide to reinvest distributions for a year or forego part of what's available, you wouldn't then have a liquid reserve of multiple years worth of spendable balances in the future. So we always want to clarify that point in advance. And then last, for administration, but certainly not least, we have OCF's administrative fee schedule. And this fee is just what it sounds like. It pays for OCF's administration of the fund. OCF endowment partner funds receive a reduced administrative fee of about half that of any other fund type at the foundation. And this fee is tiered with the base starting at 0.5%. And as your fund grows, or if you open additional endowment sub-funds, OCF combines fund balances in order to help meet fee breakpoints. So you'll see that first breakpoint is at $1 million. And once the fund crests $1 million, the balance above that threshold receives a further reduced fee. Let's see, it looks like we do have some questions. So we have Julie Gregory up next, who will be discussing how OCF can support your planned giving efforts. But we can take this one here. What is the difference between realized and unrealized gains and losses? So I don't know if you want to take that, Val, it's back to your section, or I'm happy to jump in here.
I love answering this question.
Okay.
Okay, so imagine, let's see, you buy a stock, I don't care, ABC stock, and you bought it for $100. And a year later, it's worth $250. So you still hold that. So it has increased by $150,000. It just went away. So that asset increased by $150,000. So it had a change in market value by that amount, but you haven't sold it. So that's unrealized. But the minute you sell it, so after that time goes by and you actually sell the asset and you have a gain of $150,000, well, that's realized. So I was talking about, when the markets are down and in negative territory, when the value of the assets are down, and that's not when you want to be selling those assets. You want to wait till things have improved, and then you make any kind of trades. So hope that answers the question.
Great, and I don't see any more questions at this point, so over to you, Julie.
Thank you so much, Stephanie and Val. And it's my pleasure to talk to you guys today about how we can help organizations increase the size of their endowments by spreading the word about opportunities to support the mission of your organization through planned giving. So it's estimated that nearly 45 million US households will transfer $68 trillion over the next 25 years through their estates. Just to give you some context, the GDP of the United States is around 22 trillion. So quite a bit less than that. So much of this, of course, will be transferred to heirs, but a lot of it will go to the IRS. And so charitable planning is a great way for people to reduce their estate tax liability while supporting organizations they love. And there's a lot of potential there. $68 trillion is, to me, an inconceivable amount of money. So most nonprofits don't have the luxury of having a planned giving person on their staff. So it's my job and the job of my fellow philanthropic advisors around the state to offer that support, and we love doing it. So what does that support mean? It means whatever would be the most helpful. So we often make planned giving presentations to boards, to groups of donors. We can meet with you and your donors and perhaps their attorney on an individual basis. We've had a lot of success as speaking as part of an overall presentation about the organization. When an organization gives presentations to a group of donors, say, we can slide in at the end and talk about endowment and how your donors can help support your endowment. So, and we're all happy to brainstorm with you about fun opportunities and ideas to spread the word to your donors. So looking at our first slide here, what is, sorry, could you go back, Jen? Thanks. What is planned giving? Of course, the easiest thing is bequests. When someone names an organization to receive some certain, a percentage, or the residuum of an estate or trust. Another is beneficiary designations, where someone names an organization as a beneficiary or a contingent beneficiary of a life insurance policy or a retirement account. This is super easy to do because you don't need a lawyer. And retirement accounts in particular are one of the most highly taxed assets to leave to heirs. Sometimes as much as 65% can go to the IRS. So it's a great asset to leave to a nonprofit. And speaking of retirement accounts, we often we can also help you talk to your donors about the IRA charitable rollover. While it's not technically an estate gift, which is what we typically think of when we talk about a planned gift, donors ask about it a lot. I'm sure you all have gotten lots of questions about it. And here's another fun fact. The amount of money in retirement accounts is mind-boggling also. It's $35 trillion. It amounts to 32% of household assets. Now, a lot of those retirement assets are hopefully going to be used by people while they're retired, so they can do fun things like travel and all of that. But what people don't think about often is that if they pass away, that leaves a balance in their retirement account, and that becomes something they can leave to a nonprofit. It's a huge opportunity for a charitable beneficiary designation upon death, but it's also really great for qualified charitable distributions, the IRA rollover during life. So you'll also see charitable gift annuities, charitable remainder trusts, and charitable lead trusts. And those are what we call life income gifts. And we'll talk more about those for a sec. Jen, could you advance the slide? Thank you. So in the interest of time, I'm going to share just enough to hopefully pique your interest. Just know that all of these gift vehicles have multiple iterations. So CRTs, charitable remainder trusts, and CGAs, charitable gift annuities, function very similarly. As far as what types of assets can be used to create them, at OCF anyway, charitable gift annuities can be funded with cash or stock, but charitable remainder trusts can be funded with other assets like real estate. So you'll see in the chart that how this works is that donors transfer gift assets into an annuity or into a trust. Those assets are liquidated and invested in a diversified portfolio. And a percentage of those assets are returned back to the donors over a period of time in the form of usually yearly payments. At the end of the day, when the donors pass away, usually the balance in the fund goes directly to the nonprofit. Your donors qualify for a charitable deduction the year they set up the annuity or the trust. It's also a great way for your donors to defer taxes. So if one of your donors has a highly appreciated capital asset like stock or real estate, if they sold that stock or that real estate, they would have a capital gains tax liability. By transferring it into a trust or an annuity, that's not a taxable event. And so they don't have to pay those capital gains taxes when that property is liquidated inside the CGA or inside the CRT. Of course, it stays in there. And so it comes out as part of that income stream to the donor, but it comes out in a more manageable pace. It comes out in a piecemeal way. And so it really is a great way for donors to defer payment of some of those taxes. So with a charitable remainder trust, OCF can serve as a trustee of that trust at no cost. And we prepare all those documents, and the costs of the gift are assessed against the assets in the gift. So other than upfront costs, such as paying for an appraisal of a real property gift, say, your donors often don't have any out-of-pocket expenses, even though, of course, we recommend that they run everything by their lawyer, and that would result in an out-of-pocket expense to them. So these can be pretty compelling gifts. Next slide, Jen. Here's just a super simple gift illustration for a charitable gift annuity. And we can run these illustrations for you very quickly. Thank heavens there's software that we can use to run these for you. If you would like to, if you have a donor come and talk to you about an interest in making one of these types of gifts, you can give us a call. We can run the illustration just to give your donor some idea of what they're looking at. So this particular illustration I ran is a charitable gift annuity, as I said, and you can see it's funded with $50,000 in stock. That stock has a basis, in other words, what the donor paid for the stock, of $10,000. It's a 75-year-old donor. The IRS believes that this donor's life expectancy will come to an end in 2023. The annual payment to the donor is $2,700. And you can see the charitable deduction for the donor is $22,542. Now, at the end of the day, the gift to your organization can be pretty substantial, as you can see, $74,670. Depends on how investments go inside the trust or inside the annuity, but you can see that it offers your donor a chance to make a very compelling gift to your organization, which they care about so much. That is more than the amount of the initial gift, while at the same time, the donor receives that income stream for life. Next slide. So a charitable lead trust functions pretty much exactly the same way, but the beneficiaries are flipped. So in other words, the nonprofit receives the income stream, and at the end of a trust, the assets in the trust go to a non-charitable beneficiary, usually either back to the donor or to the donor's heirs. And the cool thing is that your donor can make this gift without decreasing their overall assets. So again, they transfer assets to a trust. The assets are liquidated, diversified, and vested. The organization gets the income stream. The non-charitable beneficiary can receive more money than the donor used to create the trust in the first place, just as in the previous gift illustration. So it's a pretty cool gift. And like I said, all of these opportunities have multiple iterations, and it's super fun for us to share these opportunities with your donors, because I mean, most people don't really even know these opportunities exist, and they get super excited about it. And we are happy to help you chat with them about these opportunities, which will result in increasing the value of your endowment. So that's all I have. Does anybody have any questions about any of these fun things? And Stephanie and Val, I think, are going to make an appearance, a reappearance, and they can answer any questions from previous sections too. And I really appreciate your time today. It's super fun for me to talk about these things, and I love sharing these opportunities with nonprofits and with their donors. So thank you.
Well, thank you very much, Julie. And we do have a question for you here. And it says, does OCF provide support to endowment partners for planned gifts that are not directed to the organization's fund at OCF?
The answer to that is potentially, but for example, with a charitable remainder trust, for us to serve as trustee, we ask that at least 50% of the value of the charitable remainder go into an OCF fund. So that can go into an endowment fund, or your donor might wish to create their own fund. And this is, I'll take a second just to talk about this too. Sometimes what donors are interested in doing is creating their own named fund where they designate your organization as the main beneficiary or as one of the beneficiaries. And the reason they might want to do that is it allows them for some control, because they can name a contingent beneficiary in the very unlikely event that your organization goes out of business. They can also use their fund to support more than one organization. So most people want to support more than one, and creating a designated fund at OCF named after their family, naming their organizations that they want to support is very attractive. And it's, from your perspective, it functions exactly like an endowment would function. You get that income stream just like you would from an endowment fund. So, so the answer is yes, your endowment needs to be a charitable beneficiary or another fund at OCF. Does that answer hopefully it answers the question.
Great. Thank you so much, Julie. I don't see any other questions at the moment, but we're going into the Q&A portion. So if you have them, please do share them now.
Come on, bring on the questions.
And if you think of one, 15 minutes after this ends, you know where to find us, and we'll include our contact information on the upcoming slides as well. So we're always available to answer your questions.
All right then. Great. That means our presentation was so concise that there are no questions.
Well, contact information for everyone can be found on these following slides that are going to go by here shortly. But We just want to thank you all so much for joining us today and for your partnership. A recording of the presentation as well as the slides will be sent to you shortly, and contact information is available here. So we also hope to see you all at our next webinar, which is going to be on November 4th. And it will feature CPA Gary McGee providing an overview of the accounting treatment for endowment partner funds. We'll be sending out those invitations shortly, but until then, thank you all so much and take care.
Thank you.